Insurance refers to cover for possible events that may cause a specific loss or damage. It involves two parties, the insured and the insurer, and the insurance contract stipulates the monthly premiums payable to the insurer for indemnification from certain financial risk. Non-compulsory insurance is where the insured is covered against risks that may or may not occur and is not required by law. Let's review the meaning of the following insurance concepts. Overinsurance means assets are insured for more than their market value. The insurer replaces damaged assets rather than making payouts. Underinsurance means assets are insured for less than their market value. Partial compensation is paid and the insurer applies the average clause. An average clause applies to underinsured assets in the insurance contract. The insurer pays in proportion to the insured value, and the insured takes responsibility for the uninsured portion. Reinstatement refers to a clause within short-term insurance where overinsured assets are replaced, not reimbursed. The insured is placed in the same position as before the damages. Excess refers to an agreed amount payable by the insured when submitting a claim. Excess payments reduce insurance premiums and discourage fraud. These are the differences between insurance and assurance. Insurance applies to short-term insurance and refers to the principle of indemnity. Insurance covers specified events that may occur. The cost of the potential loss transfers to the insurer through monthly premiums. Examples include property insurance, theft, and burglary. Assurance uses the principle of certainty and applies to long-term insurance. Assurance covers specified events that will occur. The insurer pays an agreed amount after a certain period or upon the death of the insured. Examples include life insurance, endowment policies, and retirement annuities. 4 insurance principles ensure the validity of insurance contracts. Indemnification or indemnity applies to short-term insurance and protects the insurer against specified events stipulated in the insurance contract. The insured must be placed in the same position as before the loss or damage, without profiting from the insurance. Security or certainty applies to long-term insurance. The insurer pays an agreed amount in the event of the loss of life or a predetermined age. Utmost good faith refers to the honesty of the information supplied when entering insurance contracts or lodging claims. Both the insured and insurer must disclose all relevant details that affect the risk. Insurable interest is where the insured must prove they will suffer financial loss if the insured object is damaged, lost, or ceases to exist. The advantages of insurance for businesses include transferring risk from the insured to the insurer, protecting businesses against dishonest employees, damaged or stolen assets. These are the differences between insurable and non-insurable risks. Insurable risks are insured when the likelihood of an event is determined. Examples include theft, fidelity insurance, and fire. Non-insurable risks are not insured as the risks are too high. The business remains responsible for its assets. Examples include damages resulting from war and marketing malpractices. These are the differences between compulsory and non-compulsory insurance. Compulsory insurance is required by law and regulated by government. Payments are in the form of levies. Non-compulsory insurance is voluntary and is not regulated by government. Payments are in the form of premiums. The different types of compulsory insurance in South Africa are the Unemployment Insurance Fund, which assists employees with financial aid should they become unemployed due to the termination of employment. The benefits include unemployment, disability, maternity, and adoption. The Road Accident Fund, or Road Accident Benefit Scheme, provides cover to all road users in South Africa, compensating for loss or damage wrongfully caused when driving a motor vehicle. The Compensation for Occupational Injuries and Diseases Fund, or Compensation Fund, compensates employees who sustain injuries or diseases while at work.